Hi, it's Arjun. We wanted to follow up on our post from last week called Reflections on the End of the Energy Transition Era to provide some commentary about some of the important lessons learned really over the last 5 or 6 years from what was really an insane period of time for energy markets and all that went on and around it. This week, we're going to dive into the topic of governance, which can be a little bit of a black box for investors, especially if you don't have a history of serving or interacting with boards. But I want to include an important disclaimer up front, which is all of my comments this week are based on my 32-year career as primarily an energy equity research analyst. They do not pertain to any specific companies either I or Veriten are involved with. These really about sort of broad lessons learned over the course of my career. And just as a reminder that if you are listening to this on Apple or Spotify podcasts, there is also an accompanying video that you can find on Substack, Veriten, or our YouTube channel. And then if you only watch the videos and listen to these podcasts, on the weeks we don't publish a podcast, there typically is a written post that you can find also on the Substack or Veriten websites. So I want to start with sort of a broad overview of some of the key topic areas we're hoping to address both this week and in coming weeks on some of the major lessons learned from the energy transition era, which we date as being the period from 2019 to 2024. I think the first topic that we're going to discuss this week, which will be board governance, which matters a lot to the strategy choices that companies make or frankly don't make, and it can be a bit of a black box for investors. We will talk about how counter-trend M&A can create significant value. And then the last two I think I'm going to put together here, which is this issue of scenario analysis or energy outlooks. There is no place for virtue signaling when constructing scenario outlooks. You know, we've been critical of the IEA for just variations of net zero scenarios as their only sort of main toggles. But frankly, we've seen that from a lot of the larger companies in the energy space as well. Those aren't scenarios. Those are degrees of, with all due respect, virtue signaling we've seen out there. Companies need a broad range of possible outlooks that they can appropriately make strategy choices from. And I think it's something we're going to really spend a lot of time on in 2025. And related to that is this issue of how we rethink our energy and environmental frameworks. There are a ton of lessons to have learned over this last 5 or 6 year period about things that, frankly, I think are not on track to work. We are really skeptical that these sort of corporate net zero by 2050 pledges or aspirations, whatever we want to call them, is the right way to think about how you might address various environmental and decarbonization challenges. And again, I think that's just one example. There's a ton of stuff to learn, and we're going to get into that in future videos. So I want to start by providing a quick recap of last week's post, Reflections on the End of the Energy Transition Era, which we date as having started in about 2019, but having definitively ended in 2024. I think the most common definition of the energy transition is the idea that we need to get out of fossil fuels, go only into renewables and maybe electric vehicles, heat pumps, a few related technologies, and do all of that by 2050. There's no part of that type of framework that ever made sense. But then you marry that with some of the policies that were pursued, which primarily consisted of, in Western countries, yelling at your own oil companies, whether that's in the United States, Canada, or Western Europe, pursuing keep it in the ground supply policies in those same areas, subsidizing currently uneconomic technologies and somehow believing they can ramp up quite quickly, and believing that global energy demand will somehow plateau in a relatively short number of years due to electrification of everything and other efficiency cases. Just no part of whether it was the basic definition or the policies that were pursued that we thought ever made sense. It is why we created Super-Spiked in the first place, why we started re-engaging on Twitter, and ultimately what drew us to Veriten, which the name means truth and energy. There is no part of this, the energy transition, that we think is on track to occur, and mercifully, it is coming to an end here in 2024. The arc of the energy transition, we don't tie to necessarily US presidential administrations. This is not a Republican versus Democratic kind of thing. We'd say that the energy transition, basically the idea of it started in 2019. The first net zero by 2050 promises came from Repsol and Nestle, two European companies, 4 years after the famous conference of parties, the COP meeting in Paris in 2015. And that's when this era really took hold. And of course, it was the depths of COVID, the very low oil and gas prices we had in that time, some of the social unrest we saw, especially in the US, but around the world, which drove this notion that we need to have the energy transition right now. We need to have it fast and hard. And everyone, by gosh, is going to be net zero by 2050. It also coincided with the rise of ideological ESG, which we differentiate from some of the traditional variables like governance, which we're actually going to talk about this week, or maybe the quality or makeup of management teams and boards, which we're also going to a little bit talk about this week, or traditional health. That used to be the traditional focus of ESG. It has, I think, still some relevance. But when that morphed in 2020, 2021, maybe 2019 as well, to climate action, corporate climate action is all that matters. That's been a huge issue. And we're going to say both this sort of net zero framework, the energy transition, and the corresponding ideological ESG, those are coming to an unquestioned end here in 2024. I think one of the big ironies of the last 5 or 6 years has been the consensus would have been Trump bad for clean energy, Biden good if we just look at a US framing. In fact, for the best years for the iShares Clean Energy ETF, ICLN as it's called, or as its ticker is, 4 best years were under Trump. They've done terribly under President Biden, and the opposite has been true for traditional oil and gas. Did really poorly under President Trump's first term and have done generally very well under the now nearly 4 years of the Biden administration. So it's just an irony of this energy transition era that even the consensus expectations of how it will play out generally did not turn out to be true. So let's get into this topic of governance and some of the key lessons learned over the last 5 or 6 years. And maybe just a step back here. A board does not exist to manage a company. Management manages the company. So as a board, you hire a CEO, and that CEO runs the company with their direct reports, their indirect reports, and so forth. Your job as a board member is to oversee how they're doing and to help them think through some of the key strategic decisions, to point out blind spots, to offer different perspectives. And maybe I'll pull up the first 2 questions here. So, and this can be very hard to judge from the outside. You know, my career was, the part of my career was as a sell-side equity research analyst at Goldman Sachs. And honestly, in those days, I did not spend, I don't think really any time directly trying to evaluate or deal with the boards of the companies I followed. It was very much, I'll say, a black box. There were these people that sat on these boards. You might recognize some of their names, you might not. But I don't think one really knew how they impacted some of the key strategic decisions a company made, which essentially is where they can best be served. And so you think about it, I have these first 2 questions. What is the board and management's culture for robust and constructive discussions? And again, robust, but also constructive. This isn't about being adversarial per se. There may be times where there are stronger disagreements, but this is about helping the process along. As a board, if you have made a good decision in hiring a CEO, you're hiring them because you trust them and you have confidence in that person to run the company well. And your job is to help ensure that all the risks, rewards, pros, cons, different perspectives are brought to bear. Ultimately, though, management runs the company. If you think that's not going well, then you can perhaps make the tough decision to make a change. And are a range of views reflected in the decision making? If you, as an investor, were to have any CEO come into your office and ask them, do you have robust and constructive discussions? Are a range of views reflected? For sure, they're all going to say yes. How do you know that from the outside? I'm not sure you can. What I would say, though, is we're going to go through some examples of, I think, how this energy transition played out, and you can a little bit see it in the performance. Why, in some cases, some companies make some terrific decisions during this. I mean, it was a really traumatic period over the last 6 years. We were coming out of 2016 to 2019 when the traditional oil and gas sector was generally struggling post the oil bust of 2014, 2015. You then had COVID, negative oil prices, really bleak time. You had all this energy transition narrative, which created some sense of sort of existential risk to the industry. Is oil and gas demand going to go away in some near-term time frame? Then you have Russia, Ukraine, this incredible boom period immediately after one of the worst troughs ever, COVID. and sort of a second life, but where there was still this nagging doubt about the pace and scale of, quote, energy transition and what it could mean. So like a lot going on. A very challenging time to be managing a company or to be on a board. And there's no question some companies did better and worse through this period. Anybody can make mistakes. This is not about being perfect. This is not about 2020 hindsight. It's really what went into the decision making at the time, where one could have said, yeah, the risk reward on this is good. It's too bad it might not have worked out, but there was a good process, if you will, going into it. And again, I think this is very hard to evaluate from the outside. I might give two examples from this most recent era. One was, there's no question, the companies that did transactions sort of at or near that COVID trough, I'm talking about oil and gas companies now, in that 2020, 2021 period where oil had gone negative and maybe it rebounded to $20, $30, $40 a barrel, but still very low. Those transactions have generally been home runs, I think, broadly agreed for the companies that did them. Going into that downturn, this is not about, did you forecast COVID or did you think we were going to have negative oil prices for a day in 2020? It is about what was the balance sheet strength of a company? What was the discussion process around that? Yes, a CFO or maybe a CFO with the CEO is going to say, have views on debt to cap and debt to EBITDA and covenants, how well are they covered? There'll be all sorts of decisions that the management should make. But if a company was taking steps that might have resulted in the balance sheet being levered, what were the discussions around it? Did a company consciously go into a period where they were more at risk, or the opposite? They cleaned up, they'd done asset sales and so forth. Again, I think very hard to judge from the outside, but one thing I'd offer is it's not an excuse to say we couldn't have forecasted COVID. You can never forecast the specific downturn, but how is there any doubt that this is a deeply cyclical sector, that stuff happens often unexpected, maybe because of geopolitics or otherwise, or because some economy that you weren't expecting suddenly has a tailspin, or there's a geopolitical supply disruption. There could be, as we had with Russia, Ukraine. There's lots of things that happen. And I think this is where there is a real opportunity for boards and managements to engage in really healthy discussions and consciously make decisions. You might have chosen to have had a slightly weaker balance sheet in what turned out to be the COVID period. If you made that decision purposefully and you can live with the decisions you made, in the event a deep down cycle is going to happen, then so be it. I think this is where boards can really make a large difference in how they interact with management teams in providing their perspectives. Another big example from the last 2 years is this question of energy transition. And if you're an oil and gas company, to what degree should you be getting into investing in the new stuff? And I think everybody knows it well by now. The European oil companies, the super majors, to a much more aggressive degree, went into the new stuff and rebranded themselves, quote, integrated energy companies. And we saw almost none of that, or certainly much less of it, happening in the US. And there's a huge role for boards to play in these kind of discussions. And I'll say a couple things here. It can often feel like, well, the larger companies must have, quote, better boards because you're going to recognize more of the people on it. They were CEOs at major companies or other high profile people. And I would just say, large companies, small companies can have good and bad boards. There is not, in my experience, a correlation to size. It is true that larger companies often have more resources. And so I think all the big companies, whether European or US, they could spend time studying energy transition technologies, running scenarios, or so forth. But there was something about some of these groups of companies going much more aggressively in a direction that I felt at the time we were strongly against. Companies in the traditional space going into stuff they do not know, they did not know about. And you're now seeing some of those decisions being reversed. I don't view that as 2020 hindsight. I felt like we knew it at the time. What was the role of the boards in how they thought through these things? And if you have a board that is more, quote, elite in nature, you might have them be more willing to say, yeah, energy transition is a hot topic. Maybe they're not as big of experts on the energy sector. And they're saying, you know what, sounds true. Oil demand might go away in the next few years. Let's change our company. This is the example to me where boards can make a really big difference. And I'll give you the small company examples. It has been my experience that there is a lot of thoughtful discussion that happens at the smaller companies, including with board members maybe most investors will not have heard of. And yes, the resourcing that large company has may not be there, but there were tons of questions asked about, okay, we're hearing about energy transition. What is the fate of oil demand and how might that impact our shale strategy or whatever the case may be? Are there some of the new technologies that does fit with our company? It's probably not the mega projects like hydrogen or what have you, but maybe there's a lot of thoughtful discussions. So this is not about size. I think this is where a board can make a huge difference in how companies perform. I'm going to show a picture at the end that goes into that a bit more. Let me pull up the other two things I wanted to talk about in this topic, which is who has the judgment, and I'm going to say, and the guts to make that bold, unexpected call that kind of cuts against the grain of where everyone else is headed at the critical moment. This is where you can get substantial outperformance, especially if the unexpected decision works out. And similarly, and by a similar vein, who resists temptation? Especially when we're talking about deeply cyclical sectors in the traditional oil and gas space. I'm talking upstream and downstream and everything in between. When the cycle is going in a certain direction, it can be very tempting to go along with what the crowd is doing. These sort of critical or bold decisions, they may not be, well, we should do this acquisition or not. It can be something more subtle about how you adjust your management team, who reports to whom, how you restructure your company. There's a gazillion decisions that companies make. And then what is the board's role in sort of supporting and recognizing, you know what? Now is not the time to go with the flow. We should actually cut a little bit to the left or a little bit to the right. I'm going to use maybe a couple examples of variable dividends as an example. So as we went into Russia, Ukraine, and companies were suddenly flush with cash flow and the balance sheets were getting improved, there was a lot of pressure out there put on by investors, frankly, to dividend some large portion of that back to shareholders. And it makes sense. I want to be clear, I'm not against dividends or variable dividends. We're hopefully by now, huge proponents of return on capital and returning cash to shareholders. But there is a question about the degree to which one should do it versus paying down debt and building up cash for the inevitable next downturn. And it is quite possible that when we look back at that 2022 period, there were some companies that probably went too far in their variable dividend strategies. I think some of it was absolutely needed by everybody, but maybe some went too far and wished they'd had some of that cash on hand today is one example. I think an example could be in the low carbon space where we saw a lot of these renewable diesel conversions. I understand why they were done. You're turning a sort of a cost or an obligation to hopefully a revenue stream funded by the subsidy, the tax credit that you get on the renewable diesel sales. And there's a low carbon fuels credit that California gives you. I understand why they were done. They were not all good decisions. How do you, again, resist temptation is, I think, and there's a huge role for boards to play. It is really tough when the cycle is strongly in one direction or the other to resist temptation of doing what is popular at the moment. So the final slide, I want to provide an example of, it's going to look like a stock performance graph, but really how governance decisions, I think, has resulted in some very divergent performance. And these are all, and so, well, first of all, I apologize. We are not going to talk about specific companies publicly here at Super-Spiked or at Veriten. So I've labeled these companies A, B, C, D, and F. This is market capitalization. We've taken away the axis, so one can't, exactly figure out who the companies are. I think if you're a former client, a professional investor, you already know these examples. And I think if you're not, it's not really the point. But we want to talk about how, when you think about oil and gas companies, often it's like the oil price is all that matters. They all go up and down together. And I get that can be true in a short-term period, a week, a month, maybe even a quarter. But over longer periods of time, this is going back essentially 10 years, back to 2015, which was the start of, or was the end of the super spike era and kind of leading into what we're going to call this, quote, the energy transition era. Let me just go through the examples. So let's look at company A, which is the black line, and let's compare them to company B, which is the red line. Company A, I don't have the scaling here. They were larger than company B throughout this period. But if you look at this sort of, and I think you can see my cursor, 2020, 2021 period, this was the heart of COVID and quoted the energy transition. Very different decisions were made strategically between these companies in terms of how they thought about low carbon or how they thought about the traditional business. And you've seen basically the positions flip, where now company B is meaningfully larger than company A. Again, these are ones where I'd say more dramatic action clearly showed a big difference in performance. And I'm going to say the boards of these respective companies had a huge impact on, or at least a supporting role in how this played out. Let's compare company A to, I think, the most extreme opposite example is company F, which again, if we're just looking at this beginning period, company A is massively bigger than company F. You fast forward a decade later, company A is smaller than it was 10 years ago. Company F, which would not have been in the same universe of company A in 2015, is still smaller, but is now within shouting distance, and frankly is a merger of equals away from being the same size. It's an incredible difference in performance. Credit to the management team of company F, but undoubtedly supported by the board, which along the way had a lot of tough decisions to make. And it was not a perfect smooth line up, as you can see with some of the jaggedness in the performance along the way. But over time, there's been something very healthy about how this company's both been managed, but as well governed. Let's look at a couple other examples. I'm going to highlight company C and D, where there has been less dramatic, specific strategic decisions made. Again, A versus B was more dramatic. I'm going to say C and D were less dramatic. And here again, A much larger than C and D, yet we look at a decade later. And maybe this is tortoise versus the hare. I'm not sure what the right analogy is. But C and D incredibly have caught up to company A. I'm going to use C and D as examples where that combination of governance and management has resulted in just slow and steady, excellent results. And so again, these are all oil and gas companies. I know I'm not giving the names, but you would have thought they're all just driven by oil prices. That is not true. It is absolutely not true. The strategic decisions these companies have made have resulted in these big divergences that when you look back over a decade, has resulted in dramatic outperformance. And probably the last one that I haven't mentioned yet is just company E, which again, larger than C and D, but here we look, 10 years later, and C and D are now bigger than company E. The point is simply governance, the running of these companies, the managements, it can make a huge difference in performance, which is the point of showing this graph. And again, I'll apologize again. I apologize, I'm using A, B, C, D, and F. It'd probably be easier to talk through the actual names, but this really is about the spirit of what we're talking about, not trying to pick. We don't want to pick on specific companies publicly, that's for sure. We don't want to praise companies for that matter either publicly. So I'd like to end this video on a personal note and really wish everyone happy holidays, Merry Christmas, Happy Hanukkah, Happy New Year, whatever you celebrate, happy whatever that is. And I hope everyone enjoys some time with family and friends. This will be our last video podcast of the year. We will come back at some point in 2025. We're going to take probably 2 weeks off. We will most likely do a written post next week, which you can look for. But it's been 3 years that I've been on Substack. It is the holiday season. I want to wish a special happy holidays first to those first, it was 19 subscribers that signed up on November 15th, 2021, 6 days before my first publication, where I was playing around with the Substack website and thinking, do I want to do something that starts talking more publicly or not? I'm not so sure. I think I linked it to my Twitter account and I didn't realize it was going to send a notification. So before I'd even decided, do I want to do this? Those 19 people signed up. The first person, I'm going to just go with first names, is Rob. The second person was Dimitri. And those two in particular, but then the other 17 that followed, suddenly was like, okay, I got to do this. People have already signed up for something I'm not even sure I want to do and haven't started yet. And I think those two people for sure followed me on Twitter. So it gave me some encouragement. But I want to thank, I like all my subscribers, but especially those that motivated me to kind of move forward with this. And then secondly, I would like to thank Substack for existing. It makes independent publishing really easy. And in a world where there has been some rightful critiques of a lot of the legacy platforms, whether that's newspapers, whether that's network news or cable news, lots of issues that everyone knows about. This is not about controversial social issues. I try to avoid that in Substack. What I will say though is the idea to hear from a range of people, and you may not like all of them, you may not agree with all of them, and not all of them are going to be good, but the opportunity to access independent views, differentiated views, to hear a range of opinions, to get out of that censorship infrastructure that has slowly crept up, and especially our country here in the United States. Thank you and happy holidays to everyone at Substack. It is one of the things I am most grateful for on a professional level and frankly on a personal level. I get a lot of different perspectives thanks to independent new media organizations, including Substack. With that, on the video, we'll see everyone in several weeks. In the written post, we'll see you for one last one next week. Thank you.